CCL Products, engaged in the production, trading, and distribution of coffee, saw growth in consolidated revenue despite the supplies to Russia getting impacted by the war. CCL supplies 20% of the volumes to Russia. On the branded coffee business, CCL turned PAT neutral in FY22. Year-on-year, revenue growth was on the back of 7% volume growth and balance on higher realizations. CCL was not able to dispatch nearly 500 to 600 tons of coffee to Russia on account of the conflict, which will be shifted to the June 22 quarter. Despite higher employee costs and lower operating leverage, control over other expenses led to an almost flat EBITDA. Domestic business reported revenue of 200 crore rupees in FY22 against 140 crores in FY21. Branded business makes up for nearly 70% of domestic sales. CCL is targeting 40% growth in FY23 on the back of higher distribution in South and North India. Working capital remains on the higher side as CCL is keeping more inventory than usual due to the various supply chain bottlenecks. Currently, inventory day cycle is around 130 days as against 70 days 2 years back. Receivables are on the higher side on the back of higher volume supplied to US retail giants. Once the bottlenecks are behind, CCL plans to go back to the earlier inventory days cycle. Current capacity utilization at Vietnam is 80 to 85%, which is the optimum utilization level. CCL plans to increase the capacity at Vietnam and India. In Vietnam, capacity is likely to increase from 13,500 tons to 30,000 tons. Management expects commercial production from the increased capacity from the March 2023 quarter. The total capex in FY23 for Vietnam is about $30 million and the India capex would be about 30 to 40 crore rupees. We remain positive on CCL on the back of its cost-efficient business model, expertise in coffee blending, and capacity addition in value-added products. Realizations are also likely to be higher from March 2022 on the back of rising green coffee prices. However, EBITDA per ton is unlikely to change much as CCL adopts a pass-through model. Management has guided for volume growth of 15 to 17% in FY23. The volume growth drivers are strong order book, doubling of capacity in Vietnam, and about 35 to 40% growth rate in the domestic branded business. CCL continues to look for opportunities in the international market. Going ahead, it plans to focus on small packs for the US markets. CCL is also targeting newer markets in Europe on the back of its strong brand visibility in most regions. Russia, being the second largest market for CCL, is likely to face some disruption due to the war. With Brazil impacted by lesser rain and lower coffee production, Vietnam and India are likely to be the preferred choice for consumers, and CCL has presence in both the countries. Arabica prices are likely to remain elevated for the next 1 year at least, as Brazil, which is one of the largest producers, is facing an internal crisis. CCL won't be impacted as 85 to 90% of its requirement is of Robusta coffee. Based on the current estimates, CCL is trading at a PE multiple of 16 times FY23 earnings. Investors with a medium to long-term horizon can accumulate at the current levels and add on declines. The risk to our assumption remains disruption at its Vietnam plant and a prolonged war between Russia and Ukraine.